So as major US stock market indices start to push towards the correction territory, you always see the two typical type of investing persona. On one hand, you have people raising the white flag, surrendering, thinking that the bull market is over. And on the other hand, you have another group of investors secretly turned on. And don't tell anybody, I'm part of the second group. But anyhow, I think it's not a secret that the stock market tend to work in mysterious ways. And in this most recent sell-off, it has wiped out more than $4 trillion worth from the peak in Feb, when Wall Street was very much cheering on Mr. Trump's agenda. And not forgetting, on the flip side, when Trump was announced the winner, you can see a net asset outflow from many of these China equity funds. And as I alluded previously, just when everybody thought that there was no hope between the US-China tension, the Chinese and Hong Kong equity market is actually one of the best performing asset class, at least year to date in 2025. And in the name of transparency, and to also flag out my own personal biases, personally, I'm still extremely super overweight China. And this is one of my portfolio that is probably 90% China, and you can see it's more than 20% up year to date. On the other hand, I have a more hybrid blended portfolio with around 60-40, 60% China, 40% US. And yes, the US positions year to date did not do too well, close to 12% year to date. And of course, skeptics will push back and say that, any donkey can outperform in the short run too. So just to flag out my own longer term performance, this portfolio started roughly a bit more than 2 years ago, and it's sitting at roughly a 24% CAGR. This is the blended portfolio with 60% in China and 40% in US. And I think for longer term followers of this channel, you know that I've been a huge Chinese equities advocate for close to 4 years now. And looking back at all my legacy position, this portfolio started at the start of 2021, and you can see that yes, it's true that I'm still trailing behind the S&P 500, all things considered. It's roughly sitting at around a 7.4% CAGR. And we've also accumulated some of these names in the 2022 inflation bear market. So this is just to set the context right on the onset. So I think the bigger question at the back of your mind is that what exactly am I doing in this stock market volatility? So for those of you who have not yet followed me on Substack, link is in the description below. I actually do provide more real-time updates there, and this is just some of my recent moves on what I've been buying. And surprisingly or unsurprisingly, these names happen to come under this category called the Magnificent Seven. So specifically in this video, we'll be focusing a lot of our efforts into trying to dissect the risk-reward opportunity and how I look at the individual 7 names. And if that's right up your alley, remember to smash the like button to show your appreciation. Now, the Magnificent 7 in 2025 doesn't seem so magnificent anymore. So as of the 10th of March, other than Meta, the rest of the other Mag 6 stocks experienced a decline of between 10 to 20%. And of course, Tesla, always being in the world of its own, crashed close to 50% now. I've also seen such variations of infographics being distributed online, trying to compare some of the valuation metrics amongst some of the largest AI, tech, or semiconductor companies. I believe, I think most investors just want some sort of a framework or benchmark for comparison to look at the valuations today and to maybe guide some of their investment thinking and thoughts around the companies today and what stock can potentially be in your watch list or whether you can buy them or add them to your portfolio. So specifically for myself, I don't necessarily like to rely on other people's curated or edited data, because they might potentially have a particular agenda or narrative to push. And I've took the liberty to plot out some of these figures and numbers that I think it's important to myself, and I will then go through with you in this presentation. And on a side note, for my Singapore audience that is looking for a broker that offers lifetime commission-free trading for both US and Hong Kong stocks, look no further, as Longbridge is a new broker in town with an MAS license. So they are recently running aggressive sign-up promotion campaign that lasts until the end of March, and all you have to do is to deposit a minimum sum of 2,000 Singapore dollars and maintain it for 30 days and to complete 3 buy transactions. And you'll get campaign rewards of $50 worth of options cash coupon, 1 Nvidia share that is worth roughly 180 Singapore dollars, and also a 60-day 8% interest rate cut worth up to 27 Singapore dollars. And if you have a larger capital sum and you can maintain a net deposit of 10,000 Singapore dollars for 90 days and complete 5 buy transaction, your Nvidia share actually get bumped to an Apple share that is worth worth 320 Singapore dollars. And on top of this, you get an additional $18 affiliate exclusive if you use my link below. So the total rewards for new users to Longbridge is $18 exclusive plus $66 worth of options coupon and $180 worth of Nvidia share, and that's $264 on a $2,000 deposit for 30 days. And for those of you without a Longbridge account yet, I think this is one hell of a deal. So sign up link will be in the description box down below. And with that in mind, let's go to the first company in the Mac 7, Apple. I believe most of you would already know this company unless you're living under a rock, and it's the largest company by market cap in the entire world. And just looking at their current revenue attribution by segment, and we can see the iPhone still accounts for more than 50% of their revenue. But just going down the line, looking at their services segment, they're actually growing at an extremely healthy rate. But just looking at how Apple has performed over the last 2 years, from 2022 until today, the revenue is probably almost flat, and you can see here the numbers are ranging between -2 to +2. And moving out into 2025 and 2026, the Wall Street consensus is they're going to grow probably between 4 to 8%. And just looking at their valuations multiple, they're definitely not cheap. Forward PE, price to free cash flow or operating cash flow, they're easily above 30 times. And how you actually appreciate this value is, simply put, you can just do a 1 divided by the number, and that you will get the percentage yield in terms of earnings or in terms of free cash flow. So take an example, they're trading at a forward PE of 29 times, meaning to say, let's do a 1 divided by 30, that represents that they're trading at roughly a 3.33% earnings yield. And on the other hand, I'm looking at free cash flow, and 1 divided by 33, that's close to 3% in terms of free cash flow yield. And comparing it to the 10-year risk-free treasury bond, they're offering more than 4%. And it just means that Apple as a company is definitely trading at a premium where people are willing to take an even lesser yield to their earnings because they probably expect some sort of a growth or stability of this company. And just looking at my one-page summary for Apple, I think the bull argument is pretty simple. Apple has a very long-standing track record, and at least over the last 5 to 8 years, they have been a cash flow printing monster. Services as a percentage of revenue continues to climb, so they have a solid brand and network effect. And for those Apple fanboys that are already in the ecosystem, I don't see why they'll be switching out anytime soon. So they can also buy back their shares and continue to engineer a steady EPS growth. So the bear argument, on the other hand, is that there is a particularly challenging growth outlook ahead, especially in China, and they have a lot of unexciting AI/product launches, which could be both a good or bad thing. Just anecdotally, even myself as an Apple user, I have the iPhone, I have the MacBook, I have the watch, I have AirPods, and I'm still using my M1 MacBook and my Apple Watch and AirPods. I don't see the need to upgrade. And secondly, I think everyone also knows this business extremely well. It's easy to estimate. I think it's quite hard for Wall Street to miss a lot of their growth expectations. Hence, the valuation tend to be quite fully reflected, and that's my own personal belief. And of course, we have Uncle Warren Buffett on the side, selling and trimming a huge load of their Apple stake. And even without great growth expectations, which is now hovering between the mid-single digits, many are still willing to pay a premium at 30 times PE. And my opinion is, it's a great business, it's a great stock, many investors has profited massively, but personally, I don't see the upside for now, and we'll wait for the multiple to continue re-rate downwards and when people don't like Apple anymore. So moving on to Microsoft, we can see that over the past 5 years, revenue growth trend, they're currently at their all-time high revenue, margins, gross profit, everything is at all-time high, one of the most resilient businesses out there, and they're still growing at respectable growth rates. The last 2 years, growing roughly at 7% and re-accelerated back up to the mid-teens of 15% just this year alone. So expected moving on into the next 2 years, they are growing at between 13 to 14%. So moving on to their valuation multiple, I'm looking at their price to earnings. In terms of earnings yield, they are trading close to Apple. But looking in terms of their free cash flow and operating cash flow, OCF don't look too expensive or too heavily valued because a lot of the capex is not being accounted for. And we know Microsoft has made a lot of headlines talking and guiding investors that they're going to invest a boatload amount of money into this whole AI and cloud infrastructure. That's why their price to free cash flow is at a rate zone of more than 40 times. But you do have to make a distinction between growth and maintenance capex. And right now, many of these hyperscalers, we will talk more about them later on, a lot of them are plowing many of these capital back into growth, growing out their AI and also their cloud infrastructure. But that said, however, a lot of all these numbers are murky. We don't have the exact breakdown, so we can only trust the management team's guidance and how they intend to allocate capital effectively. Bull argument for Microsoft is simple. They are one of the most well-diversified and recession-proof companies. And even in an outright recession, we don't see people signing up for lesser Microsoft services. But yes, you might argue that gaming revenue, PC revenue might go down. But I think in the long-term trajectory, Microsoft has already proven their business model resilience. And coupled with a strong tailwind in cloud, they are expected to continue to grow between the mid-teens figure. But on the bearish side, like I've alluded previously, they are currently undergoing their crazy capex investment era, and that's hitting their free cash flow profile extremely heavily. And like many other hyperscalers, you can't see the value being accrued to the business yet. Yes, we do have Copilot that is being touted by the CEO on many occasions, but I think it really becomes more of a feature that is being bundled into the Microsoft suite rather than a standalone selling point where the company can extract value. And that's where you have to do the distinction there, whether customers or consumers in this case really cannot survive without Copilot, or whether there are other alternatives and they're being forced to pay for Copilot. And when the product or even the service itself is not sticky enough and there's no clear value proposition on why people should pay for that, it's quite hard for the company to extract any forms of value. Specifically for valuations, I think personally, I still find them a bit richly valued. Compared to Apple, I'm more than willing to pay a lot more for Microsoft in terms of the premium, but I do still look forward to want to get them on the cheaper side. So similarly, it's a wait and see. My personal opinion, I think Microsoft has always been a business that I want exposure in my portfolio, but always never had a chance to add due to the quote-unquote premium. But I guess we cannot be too greedy. I will adopt a wait and see approach for Microsoft for now. Now, moving on to Alphabet, which is the parent company of both Google Search and YouTube. Looking at their past 5-year track record, they're currently at all-time highs. Yes, there are some concerns that we'll talk about later on, but looking at the revenue growth rate for the past 2 years, between 9% to 14%, expected to grow out next 2 years between 10 to 11%. Their valuation multiple, you can see that yes, everything is shining green, because I think comparatively speaking, Google is probably one of the most quote-unquote undervalued. Okay, maybe I shouldn't say undervalued. They're relatively priced at the lower premium compared to the rest of their Mac 7 counterpart. And we are looking at valuation multiples between 16 times to even 21 times. So the bull argument for Alphabet is that they're the largest advertising player, they manage to monetize the search intent, and they own some of the most valuable internet properties that we know of today. So valuations are pretty attractive, everything considered. I'm looking at their growth and margins, etc. There's a reason why they are one of the cheapest, relatively speaking. I think looking at Google's story today, it's a little bit broken. I think the ChatGPT moment for LLMs have really called into question the paradigm of both search and advertising. And truth be told, if you want to extract an answer out from me, I don't necessarily have a very strong conviction or answer at this point of time yet. To me, it's a let's monitor and see how Google progresses in terms of their growth rates and their margins. That said, I think their financial numbers for now still proving the skeptics wrong, because the search behavior of the general public might be undergoing some sort of a paradigm shift in the coming 5 to 10 years, and that will immediately threaten the largest revenue generating machine of Alphabet itself. On the other hand, YouTube and cloud, they're still growing pretty nicely, and I don't think that in the short to even medium term, they're going to be replaced by some of these LLM concerns. And Google Cloud, they're still competing extremely aggressively and competitively with Microsoft Azure and also AWS. And also not forgetting that the advertising industry is quite cyclical too. So if this whole entire recession tariff narrative do come true, I think it will inevitably hit their numbers and their growth rates. My own personal opinion, I already have an exposure in Alphabet. I will continue to have the exposure, and I'll build my understanding along the way, and I don't wish to harp onto the monopoly story of the past decade. At least for now, I'm looking at the current valuations, I think there's quite a bit of margin for error. And not forgetting that I've accumulated Alphabet in the past 2 years, so I'm actually averaging up into this position. Now, moving on to Meta. I think Meta, I did not break down their revenue by their core segments, but instead, I broke it down by geography, because I want to give you a better appreciation into understanding how some of these different parts of the globe are contributing to Meta's top line. So looking at the revenue growth rates here, they have grown quite spectacularly, between 15 to 22%, even at such a high base. And moving out into the next 2 years, they are still growing in the mid-teens of 13 to 15%. Their valuations multiple, relatively speaking, I think it's the second quote-unquote cheapest, coming in right after Google. And ironically or unironically, both of them are in the advertising industry. So you can really see how the market is trying to price in their valuations today. Advertising companies, they're definitely a lot more cyclical. Heck, even the two of them at record revenue, record profits, record margin, they are very susceptible to the ebbs and flows of the economy. So not many people are willing to, I guess, pay up a premium for it because they're not as diversified or not as resilient in terms of their business model point of view. Valuation multiples, they're trading between 18 to 26 times. Free cash flow, similar story at roughly 30 times. Moving on to the bull thesis of Meta, I think they have experienced a lot in the last 3 years, and a lot is an understatement. And there was an incredible turnaround execution from Zuckerberg and his team, and the company is now running on record margins, revenue, income, etc. And it's nothing short of spectacular. More importantly, however, I think Meta is one of the largest beneficiary, probably behind Nvidia, and they're reaping immediate gains in terms of their income and revenue from a lot of their AI investments and capital allocation. So valuations are also arguably not too demanding compared to the other Mag 7 stocks. So the bear argument around Meta is that Zuckerberg is still all in into Reality Labs or the AR/VR segment. There's still not much progress, nothing much to show for, and they continue to burn innocent shareholder capital. Their capex guidance also continue to stay high, but the fortunate thing is that they already started their monetization efforts. I think similar to the cyclicality risk to take note for advertising heavy companies, I think it's hard to ascertain whether they've hit a short-term peak, at least on the margin front, but growth expectations are still healthy for now. I too want to be all in with Zuckerberg's vision, but I had past traumas, especially experiences with falling knives. I think I will continue to look at opportunities to add back to my position. This will definitely be a long-term core position for myself, but if you want to be invested from a long-term shareholder perspective, you have to be comfortable with both the capital allocation and the direction of the company, especially in this whole AR/VR Reality Labs front. And sometimes it might not totally benefit shareholder, and they are not just printing cash and rewarding shareholder like Apple. So that's why Apple is trading at a premium multiple. For Meta, on the other hand, you have to deal with the founder's obsession. So next up, moving on to Amazon, record revenue. A lot of their business segments are growing extremely healthily. Even at such a big base, I think Amazon is ranked one of the top 5 in terms of their revenue collected. They're still growing between 11 to 12% over the last 2 years. And moving on to the next 2 years, they're still keeping up the 10% or double-digit growth rates. Looking at their valuation multiple, they definitely don't look cheap. Price to free cash flow 64 times, forward PE 31 times. But the funny thing is their price to operating cash flow is currently trading at 18 times. So what's the big difference here? Capex, Capex, and more Capex. So the bull argument for Amazon is that time and time again, investors are always very impressed with their growth and ability to scale, even at such a big base. I think on traditional matrices, they will always look quote-unquote expensive, but the numbers are often muddled between margins and their capex. The high-margin businesses like AWS, their advertising, subscription, third-party are all trending in the right direction, and even in the low-margin first-party business, margins are also expanding rapidly. So you can see that it really voices down to executional excellence, and Amazon just goes into their own high capex, low capex investment era. And the numbers are really highly dependent on how much the management team decides to reinvest into the business itself. I think moving on to the bearish side, a big part of why investors are skeptical is that how much longer is their growth runway ahead as they take on more and more industries. And it goes back down to execution and getting an appropriate return on capital invested, considering that they invest a lot back into the business. And you can only see the results years later, which sometimes can be challenging for investors' patience, and they have to really trust the operator. So my own personal opinion is that I like Amazon the most amongst the Mag 7. I sometimes do find it hard to ascertain a quote-unquote fair value range or even a price target. So I just slowly accumulate along the way. So as long as things don't go too haywire or too screwed up, I remain invested and I remain optimistic in terms of how Amazon will grow out into the next few decades. Now, moving on to Nvidia, we are still seeing exponential growth and they've carried on for the last 2 years at triple digits, and moving out even into the next 2 years, we are still seeing 50 and even 30% growth rates at a relatively large base. So looking at valuations multiple, I think Nvidia is really a monster and a beast of its own. At a forward PE of 26 times and a price earnings growth multiple of 0.7, it's really quite attractive if you were to ask me. Just purely from a numbers perspective. And there's a very big caveat here, which is that expectations of the growth rate for the next 2 years have to hold. And if they don't grow anywhere near 50% for the next 1 year, then I think all bets are off. So looking at the bull thesis of Nvidia, they're the poster child of this entire AI revolution. They have basically extracted all the value from the other Mac 7 names. So their moat and growth is as strong as ever. We can see everyone trying to diversify or compete, but Nvidia is still at the top of their game. And when you can see so many of these trillion-dollar company players all being so afraid of Nvidia, it speaks volumes in terms of their moat and their execution. So the bear argument of Nvidia, I think semicon as an industry is extremely cyclical. Much more cyclical than advertising. So a lot of people are casting aspersions on whether this time is different, especially with the aid of this entire AI demand curve. So everyone is at Nvidia's neck and there's an explosion in demand in the near term. But many people are just questioning how sustainable this growth rate would be. Furthermore, they could potentially be at their peak growth margins or earnings right now. The valuation today is really not too demanding if you price in some of these growth expectations. Unless I think your baseline expectations is that their growth will go negative somewhere in the next 3 years. Then yes, I think all bets are off. Then we have to reassess our position and understanding of Nvidia as a business. And in the longer term trajectory, where do you see Nvidia going forward from here? So my personal opinion is that I think Nvidia is definitely the largest beneficiary of this entire whole AI story. And it's reflected now. It's not the same as some other companies that are trying to sell you the future of the company, and a lot of these are based on stories and how you expect the future would turn out. Nvidia is benefiting right here, right now. So for myself, I think I would size my position based on my own worldview and conviction, and I too cannot predict future demand. But I do see a very compelling space for Nvidia in my own personal portfolio. So last but not least, we have Tesla. So Tesla is experiencing some sort of a pretty big headwind in 2024. Yes, I think expectations for 2025 is that they will resume growth rate to the mid to high teens. And the valuation multiple today clearly just don't make sense as they're trading between 50 to 200 times. And actually over the last 1 to 2 years, revenue has kind of flatlined. Their largest part of the business, which is their automobile, margins have been coming down and it's one of the lowest over the past 5 years. While we see energy and services continue to climb in terms of both revenue contribution and also margins, but they still make up a very small part of their entire revenue. So for myself, if you ask me for my summary, I think I have no comments for this company. Thank you for watching. Of course, jokes aside, I don't have a bull or bear argument for Tesla. Everything is my own personal opinion, because I think that if you're to use a traditional way of looking and assessing this company in terms of their business, their moat, their valuations, you'll probably find it challenging, but their story is extremely compelling. So where I sit on this is that you really have to believe in the fully autonomous world, and Tesla must be the one that is able to extract value from it. The car company portion of the business is really quite worthless. So you must value their FSD, their robotics, their energy, which is what everybody like to tout about, which is the next S-curve. But personally, I'm not too fully sure how to value that anyway for quite some years now. Of course, if you're to force me, I can come up with something. But unless it starts trading at a killer valuation, I don't mind having a small exposure. But it wouldn't be a core holding, if you get what I mean. And I know many people actually live and breathe this company, so I'll reserve the rest of my opinions to myself. But I can see a world where they justify a much bigger valuation than today, which is Apple and Saudi Aramco combined. But the range of this probability is too big for me to make an educated guess. And then you can layer in so many of the positive and negative news cycle around the company, with Musk being distracted with Doge, Trump and anti-Trump supporters vandalizing Tesla cars, and how demand is waning. I can only say I really don't know where this company would land. So that's just my own 2 cents about it. So in terms of my risk-reward tiers, as we have talked about for 7 of these companies, here's a quick view of it. I rank Amazon the first. I think Microsoft and Meta tie at A tier. Alphabet and Nvidia tie at B tier. Apple right now, I think mostly it's more of a valuation concern. And Tesla, I really don't know how to tier them in my list. So I think in this current market volatility, I think there's no rush. You can slowly accumulate. And for those of you who have listened all the way until the end, feel free to leave your own tier list in the comment section down below. And with that, I'll see you in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.